guys, how's it going? This is Criss here. I want to do a quick video just to help you understand the big question that a lot of first-time buyers have, and even existing buyers, which is how much mortgage can I afford? So in this presentation, what we're going to do is we're going to talk about an income overview, what income's considered, what's not considered. We'll talk a little bit about debt ratios, quick mechanics on how debt ratios works and what banks consider in their calculations. And then we're going to use a debt ratio calculator, which is debt ratio is really kind of bank's language for saying affordability. Okay, so if you have a high debt ratio, you have less affordability than if you have low debt ratio in the bank's perspective. So we'll cap it off with a little spinning device, and that's it, guys. So let's get started. Here's what we have. As far as income goes, banks look at your pre-tax income. This is your gross income before medical, taxes, Social Security, 401k is being taken out of your paycheck, okay? Then if you're self-employed, they're really looking at your post write-off expense. So what that means is if you made $10,000, but you wrote off $3,000 of it, then really your final income after expenses is only $7,000. So that's generally, it's more complex than this, guys, but it's generally what the banks consider. And the last thing they look at if you have benefits like Social Security, retirement, pension, disability, they're taking a look at probability of continuance. They generally want to see about 3 years left. Otherwise, they may not award that to you for qualifying income. So just a couple things to keep in mind. As far as the way debt ratios work, it is relatively simple. If this green you see on my slide here is your gross income, the banks generally want to kind of write off taxes, insurance, food, utilities, and just say, hey, you know, they're not going to really calculate that when they're calculating your debt ratio. But that's going to be kind of in the red zone of an area that we don't want to touch so that you can pay your taxes, pay your insurance, and eat food, you know, and everybody needs some utilities. The next thing is expenses. So if you have a lot of expenses like car payments, credit cards, all of that, you're going to qualify for less home versus someone that doesn't have much in expenses. Okay, so not that expenses are bad, but it does play a role into the overall calculations. So, and what that leaves is, if you look at my mouse here, this little green area, and that's basically what's left over for the house. And so let's get into the calculator, guys. Here's what we have. As far as step one in the calculator, this is going to take into consideration, okay, well, what's your total monthly income? This is your pre-tax income. If you're self-employed, this is your receipts, but after expenses, right? And so this will be your monthly income we're going to plug into this box. So instead of $8,000, let's say your total monthly income is $9,000 per month, okay? So that's before taxes are taken out or anything else, $9,000. Okay, then it's going to talk about your monthly debt ratio. So let's say, your monthly debts. So this is stuff, pretty much anything that's on the credit report, okay? You're going to leave out insurance, your car insurance, your cell phone bills, things like that, your rent, okay? Unless you're going to be renting the house, you know, still while you're living at the other house, okay, which is very rare. So you're going to be living out, you know, all of the expenses for the most part that don't show up on the credit report. Except, be careful, child support, which doesn't usually show up on the credit report. You need to make sure that's entered in this number, and alimony, if you have like a tax lien that you're paying back. Good idea that you enter it in this step two. Okay, those are important things to enter in. But like I said, leave out insurance, cell phone bills, that kind of thing. So here's where you're at. As far as this number, let's go ahead and say it's $250 per month. Let's say your credit is excellent. Let's say your purchase price, you're trying to qualify for a $450,000 house. Now this number you'll probably play around with quite a bit. Let's say you need a loan, you're going to put $20,000 down, so you need a loan for $430,000. Let's say the interest rate is, you're estimating on is 5%. Your mortgage insurance, this is automatically calculated, by the way, based on the credit that you selected and your down payment. So, so anyway, it's not going to be exact, guys, but it'll give you a rough idea. Property taxes, again, not going to be exact, gives you a rough idea. If you're in California, it's good to just keep it at 1.25. And your insurance, and I know this seems low, especially if you're buying your first house, because you're going to think, man, my car insurance is more than that per month. Home insurance is generally pretty inexpensive compared to a car, believe it or not. And then as far as HOA, this is just your homeowner association dues. You may be 0. In fact, let's put 0 in there for now. And then what it's going to do is it's going to take you down, and number 4, step 4 is your results. This is your debt ratios. So as we can see in this situation, your debt ratio is 37. So it says you may have trouble, if you read where my mouse is, you may have trouble with some jumbo mortgages, but you'll likely qualify for conventional FHA and VA. Well, this isn't really a jumbo mortgage range, so you're probably going to be pretty safe here. So, so anyway, that's where you're at with this. So let's play around with it. Okay, we're at a 37. If you're like saying, hey, well, maybe I want a house more than 450. What if we find a house and it's 650? So let's put that in. 650,000. Let's say you have $30,000 available for a down. I'm sorry. So 650 minus 30 is 620,000. We'll keep the rate the same, all the others the same. And let's say this house is in a really nice community and it has a $150 per month HOA. Well, here's where you're at now, guys. You have a 54% debt ratio. You'll likely have trouble qualifying for conventional and conventional mortgage, jumbo and conventional mortgages now, but you may still qualify for FHA and VA. So you have a chance, but you're going to be kind of limiting the number of programs you qualify for. And then let's say you find a house down the street, but that HOA is $450 a month. Well, now you're at a 58 debt ratio. At 58, you may want to pay off some debts, lower your mortgage payment, or consider a co-signer to increase your income, something. But you're probably going to have trouble qualifying for a house at 650 with a 620 loan and a 450 HOA. So that's really how the calculator works. You're just going to really go in, input these top 2 numbers, but you're just going to play around with it. You're going to play around with your purchase price, your down, play around with some of the other numbers too, like your HOA, that kind of thing. And so this will give you a pretty darn good idea of where you might stand with the bank. But at the end of the day, you really should make it official. Even if you take and print out this calculator and show it to your real estate agent and say, hey, I want to drive around all weekend and see houses, chances are they're going to say, hey, man, that's really great. You put in the effort, but you didn't get pre-approved. You know, you need to have this stuff looked at by a professional and make sure everything's being calculated correctly, have them review your income, because it's definitely much, much more complex than this spreadsheet shows. So that's really your step 5. That's your next step, is just making official. But this, as you're just trying to get your feet wet, you know, kind of dip your toe in the pool, I think this will give you a pretty darn good idea of roughly where you're at. And so in closing, my advice, understand your spending habits. It doesn't really matter, in my opinion, what a bank says you can or cannot qualify for. At the end of the day, what really matters is what you can afford. And so if you're currently renting and you're renting and your rent is $2,000 a month, and you know you're trying to get into a mortgage and it's $4,000 a month, you got to say, man, how is that extra $2,000 going to impact me and my budget and how I spend? You know, is it going to be comfortable? Is it not? So look at your historical spending. And also, you know what, at the end of the day, this is a great tool, and I wanted to help everybody because there's a need for this. But at the end of the day, I can't tell you enough. You got to get pre-approved. That's where the rubber meets the road. This just gives you an idea, but it's really just kind of the first step to just say, hey, you know, am I in the right ballpark? You need to make sure you're in the right ball game. Okay, that's it for now, man. Click that link below to download the free calculator. And before you go, don't forget to hit like. Everything likes to be liked, so does this video. So hit that thumbs up, and we'd love to hear from you. Leave your questions and comments down below. We answer all of our followers' questions. Anyway, you guys take care. Hope this helps. Bye-bye.